What is up, YouTube? This is the Working Investor. In this video, we're going to talk about my progress towards my goal, what kind of strategies that I'm using. Again, I'm not a financial advisor. I'm just a retail investor. Counsel who you need to counsel. This is my own personal journey. With that said, let's get into the video. Let's talk about this dividend tracker, how inaccurate it is. I know a lot of people on YouTube have voiced concerns about it, and people are just giving up on it. Let me show you a crazy glitch. Look at this. I have the same exact data input, and it says total value 63,000. Well, it's down 3 grand, so maybe it was like 66, including dividend reinvestments. And it says here, look at monthly income, $29.96. Now, if you go to dashboard. If you go to your individual, I only have one portfolio, so it's supposed to be the same exact data entry, same exact portfolio value, and all of a sudden it says $27.95. So I'm going to go with a lower number just to the err on the side of caution, but it's a crazy glitch. I've also noticed that it doesn't recognize certain funds. It's very glitchy. Right now, for example, I tried adding RDTE, and for whatever reason, I know it's a new fund. It came out yesterday, but it cannot even register it at this point in time. I mean, there's no point because there's no dividend history. So let me get into the exact strategy. So if you guys heard of a guy named Dave Ramsey, right? So Dave Ramsey, we'll get into right here. Dave Ramsey, I'm like the Antichrist, not the Antichrist, but the anti-Dave Ramsey, you know? So basically, Dave Ramsey talks about something called the debt snowball and the debt avalanche. And basically what I'm doing is I'm using his strategy of debt snowball, debt avalanche in the reverse, basically not going into debt, but I'm saying I have the income snowball and the income avalanche. So the debt snowball is that you have a bunch of loans, people who have consumer debt ridden, who are horrible in budgeting or have crap happening in life. So it's an emotional way to feel better, but it does work because a lot of financial stuff is also emotional, not just logical. It's a big component. So basically, you make minimum payments on every single debt, and you just go after the smallest debt, and then once you pay off the smallest debt, you use the minimum payment of the smaller debt into the next smaller debt. So it kind of gets you feeling like that dopamine hit that you're moving in the right direction quickly. So it keeps you going. And then there's something called the debt avalanche, right? So the avalanche is that you hit, it's the logical way to go, but it's where you hit the highest interest debt first. So you reduce your expenses as fast as possible. So I'm doing the income snowball, not the income avalanche. I'm basically using all my dividends that I have that's above the amount that I invested. And here's the key word, above the amount that I invested, and I put it in to build another position. And then once I have that position built, then I use all the excess dividends that's above the amount that I invested, above my cost basis that I invested in, and then I put into the next dividend. Let me show you how this works in my account in real time. So going into my account, I have multiple different high yield dividend ETFs. Again, this is my personal taste. And I do have some options, but we won't get into that in this video. And most of my holdings are in increments of either 5,000 or 10,000, right? So I try my best to keep single stock ETFs to 5,000. And then I do, other ETFs that are, indices or a basket of stocks. I'm okay bumping those up greater. And this is for now. I could eventually bump it up to a higher number. Right now I have 5,000, 10,000. Keep it real simple. So my allocation for AMSI, which is YIELDMAX high yield dividend ETF, synthetic cover calls on Amazon, is $5,000. When you see 5,062 for net value, that means that after the dividends have been, if I'm below 5,000, I will have to 100% of the dividends reinvest until I get to my 5,000, because that was my initial investment. So if I ever wanted to liquidate this position at any point, I'm whole. I can move out and unscathed and have all my money that I put in initially. Because, number one, do not lose money. That's like rule number one, right? Rule number two, defer to rule number one. So I have also Phoebe, which is Facebook. It's my personal preference. Again, don't copy me. So again, I initially put in 5,000. So let's say, for example, we'll go back to Amazon. So you see that I'm at my goal of $5,000. My initial investment is whole, right? I don't care about the cost base. There is if you look at cost bases, you're like, oh my God, you're down or whatever. It says here my average cost is $19.81, and right now it's $19.90. Oh, I guess it is up. But I'm saying is I look at how much I I actually put into this to start this fund. My seed money was $5,000 for Ramsey. Once I'm at 5,000, anything over, when I get new dividends, I can finally roll it into the account that I want to build up. But if I'm under 5,000, I have to first get my position back to 5,000. So I'm basically buying more shares. It basically forces you to DCA in only up to a point when you're whole. Once I'm 100% whole, then all the regular excess dividend, I can use it. I can either spend it or I can use it to fund other accounts. Same thing with Facebook. You see, I'm down I've reinvested the dividends, but I'm still down about 30 something dollars. So we'll see if when it comes to dividend, payment, if I'm above $5,000, I'll be able to spill it over. If I'm under $5,000, I have to reinvest it up until $5,000. Now, in Dividend dips, so then I have these very risky plays. I consider it risky, some people don't, but I'm basically riding the momentum of volatility. So so these are my sandwiches. So basically I have Nvidia dips. I consider this one entity, and I've mentioned in many, many videos that it's $5,000 into this entity. I didn't just I put 2,000 in the dips, which is the inverse of Nvidia. So if Nvidia goes down, dips will benefit, and if Nvidia goes up, then Nvidia will benefit. And I have a 60-40 split. So I have 3,000 in Nvidia, 2,000 in dips. You can see that I'm almost at 5,000 together. I had to reinvest all 100% of the dividends on the distributions to try to make myself roughly whole. Again, I consider the dividends unusable on the last payment because I had to reinvest 100% of the dividends just to keep, to buy more shares, to keep the dividend, to keep my initial investment whole. Once I'm above my $5,000, then I could spill it over. So right now it's kind of on life support. Then I have the Tesla crash. So I had to reinvest. So Tesla is based on Tesla. Crash is the inverse of Tesla. And they both pay. Here's the thing. It's not a typical classical inverse like, you just like a classical hedge. The idea is that they both are high yield paying ETFs. They both pay extremely high yields on both sides, on the up or the downside. I'm basically collecting money I'm riding the wave of momentum. I'm riding the wave of volatility. So, and a lot of times you'll notice that there's richer dividends on the put side than the call side, because people have more fear for an underlying to drop. So hence this tends to be more put skew. So, but whatever happens, regardless what happens with Tesla, I am 3,000 in Tesla and 2,000 in crash. And you could see that I'm about $100 above my 3,000 allocation of Tesla and about $153 down in crash. So I'm almost whole. I'm almost but I had to reinvest everything this past dividend cycle. So I couldn't really use the dividends for anything else, but effectively I bought more shares. I used the dividends to buy more shares. So if the market were to go up, I might eventually be able to spill over. But for now, it just has to feed into itself, so to build itself up. So that's Tesla crash. And then I have the Coney Fiat. And this is where I'm down the most. I know a lot of people say there's like a lot of conflicting people out there. Some people saying that we're going to a crypto winter. Some people saying we're going to a crypto bull. And this recent pump was reflective of the ETF surge. And then now we're up to the normal crypto cycle. I don't know. Whatever happens, I know there's a lot of momentum. So I have Coney and Fiat. Thank goodness I had Fiat, because Coney went really down. I had 3,000 Coney. It went down to 2,100, as far as almost 2,100, almost down $900. Fiat held its position. So when I got the dividend distribution from Coney and Fiat, I was able to take both the distributions from both sides of my both opposites, and pour it into Coney. So instead of being down 900, I'm down like 430. But then I'm also up about over $100 in Fiat. So I'm down $300 to $400 total in this position. So far it's been a complete loss so far, about $300 to $400. Just went through one dividend cycle. So we'll see what happens with continuous cycles, because I have a lot more shares now. So we'll see. And I basically was able to dollar cost average my shares down in Coney. So, and again, this is a single stock ETF. So hence my cap, the way I think about it, is $5,000 total. So it cannot go more than that based on the account. Ulti is basically, I mentioned a video about Ulti, how I'm very impressed with the the new strategies that they're doing, they're trying to preserve their NAV. They have done a pretty good job. If you look at the past, even with the choppy cycle, to be down less than 1%, even with this negative, the whole market's been down pretty much. I would say it's a pretty cool strategy. And Ulti, as I mentioned, they include the top performers, the top dividend payers of YIELDMAX. Historically, they have Misty, MicroStrategy, Coney, or Coinbase, which is based on Coinbase. They have Nvidia, which is what they call, they have Nvidia, Coinbase, and MicroStrategy. Plus, they have the entire Nasdaq, so it has a lot of diversification with the entire Nasdaq. It has basically QQQ, ticker symbol QQQ. It also contains the Russell 2000 with triple leverage, which is TNA. Plus, they have Palantir. Plus, they have a lot of other. I think they have Chewy. They have a whole lot of other stuff in there. They've changed they're going to change their prospectus, but they've already drastically changed their holdings. I have not checked their holdings this past week, but so far what I've seen, they've done I like the work they've done, and they've proven so far this past week to, relative to the market, to be down barely 1%. I think they've held up pretty well. I'm looking at it as if $10,000 is my allocation, but I just wanted to buy this round even, 1,000 shares. So really, I paid $10.80 per share, so I'm just down $40 in the position. Then I have XCTE and QDTE. These are Roundhill products. These are very unique strategies. They use overnight exposure, and there's a lot of research out there that talks about the gap up and the overnight trading, and a lot of, most of the momentum of the gain of the year comes from the overnight trading. There's a lot of research out there talks about it. So here you get 0 day to expiration with overnight exposures. You get to capture a lot of the upside. Of course, the market could go down, but so far they've done pretty decent. XTTE, of course, I'm down in both positions. The markets that they reflected of the market. QDTE, I'm down. So there were $10,000 roughly in each one. And you could see there was just an announcement. I think that XCTE is giving out 33 cents per share. I think I saw it here. Well, they're coming out with, I think, 33 cents a share. And then I remember QDTE, they just had an announcement this morning, 44 cents per share. So we're talking, over $100 coming in QDTE, over $65 in XCTE. Again, I'm going to have to keep reinvesting 100% until I'm made whole, until I have my $10,000 completely back in the allocations. Once we have the $10,000 in the allocations, then I could build it up. So my builders that I want to build up is RDTE is one of them. I'm looking into it. I bought 2 shares just to keep an eye on it. I bought it through a limit order. I understand that RDTE will not have a distribution until a couple weeks from now. I think the Friday, the 27th of September should be the first earnings. I listened to the David was on the coach interview, and I think that's what he said, that it's going to be Friday the 27th, so the 25th of September should be like the declaration day. So we'll find out then what the dividends will be. I know some people think that these, and it does make a lot of sense that it could be beneficial for funds to try to pump out like a high dividend distribution to beginning, like some teaser distribution, so people are like, oh my god, they start going crazy, and then later on you'll find out what the real distribution is, which there could be some truth to it. Another reason why it could be some truth to it is because the distribution that's going to be coming out on Friday, supposedly Friday the 27th of September, it will have about over 2.5 weeks, or two weeks or 2.5 weeks of these 0 day to expiration trades of premium that it'll collect. So I wouldn't look at that first premium as reflective of every single week and extrapolate on that data, because going forward, it'll only be reflective of 1 week, because then it'll be weekly every single week. But the first week, it has this head start of 2.5 weeks. So I would theoretically not look at that, and I think it's silly to look at that and extrapolate on that first dividend, because I would imagine it will be like almost like a double dividend, punch, like whoa, which is smart in a way for companies to do. I think, why not, kind of show the customer is a big thing, but maybe a honest way to look at it is to maybe subtract the initial dividend by 2, because it's reflective of like a little over 2 weeks, and then you could maybe start extrapolating, maybe. But the truth is, time will tell. You need to have many, many, many weeks of dividend distributions. You want to see the cycle go up and down, and then you have an idea of what like the average would be historically. You have a better idea. So RDT is one of the things I want to build in if I have any excess coming in. FEPI is another one I've been building up. So now it's kind of like a matchup because now I have the new shiny object of RDTE, but for now, it seems like I'm building up in FEPI until I get a little more data of what RDTE is doing. And there's really no incentive of me building up RDTE because there's no like FOMO of missing out dividends because, there's not going to be anything until, as long as I have whatever shares I want by the 25th, I would imagine, or, the week of the 20, which the 25th has. There's no difference in me buying the shares now or buying them next week or buying them, the week after that. So right now I'm I'm kind of leaning more into building up FEPI. My goal with FEPI was 100 shares, which will be approximately $5,000 in this allocation. I have SPY-T. I like FEPI is NASDAQ-based ETFs, it's tech, but it has a different strategy than QDTE. And again, there's something called diversification, and you want to avoid duplicity or redundancy in your holdings. Like if you have like 10 different ETFs, I mentioned in one of my videos, and you'll notice that 10 of the ETFs, they hold a lot of the same things over and over and over again. You're not diversified. You think you're diversified because you have 10 different ticker names, but the 10 different ticker names hold around the same sector, same underlyings. You're not diversified. Right, so there is something called diversifying of underlying. There is something called when you have option-based ETFs, you have more diversification because you could diversify in strategy. Are you bearish? Are you bullish? You can diversify in, zero data expiration, weekly, monthly. So diversification in time. Right, you have to admit the zero data expiration ETFs, and David even mentioned it on the interview. David from Roundhill mentioned in an interview with the coach that one of the benefits of the zero data expiration ETFs is that there's a crazy market shift. Let's say over a week, the market is moving in all kinds of different choppy directions. They have flexibility because every single day they're putting on new options. They have the benefit of the knowledge of the previous 24 hours to make a decision what they're going to do in the next 24 hours. But if you have an option that's a strategy that's monthly or weekly, you're kind of locked in. You put on the trade, and now you're in that trade for the week. Of course, you could do inter-week or day trades, but the way the strategy is set up, with zero data expiration, you have like quick flexibility to move with the market and move with the conditions. So that's what I'm trying to say. Like there's diversification of time. So RDT, QDTE, XETE, diversification of time. FEPI, I think they do weeklies or monthlies, and they go a little further out of the money. SPY-T, they do call credit spread. So that's a whole different strategy on the S&P 500. I chose SPY-T over QQQT because so far they both have the same 20% dividend goal. And the difference is why on earth would I want to have QQQT, which is very similar. These are from Defiance. When SPY-T has the same goal and QQQT has more volatility and less diversification, and SPY-T has less volatility and more diversification, and they have the same goal. So for the same risk-adjusted return so far, why on earth would I want to do QQQT? That's my question. Maybe QQQT is still new, so we'll find out. TNA is an option play that I'm doing. Right now it's a little bit in the red, but I've done whatever. I won't get into the options, but I've done a close to the money. I'm doing a little below my cost basis call. It's working out pretty well, so I'm kind of bringing in some cash from it. BITO has just been like an options play, and it's kind of like a high yield dividend ETF play. Again, these things, now everything else you've seen up until here have these $5,000, $10,000 allocations. Like the Roundhills, my goal would be 10,000. Everything else has been 5,000. Whatever I could spill over, I'm trying to build up, like I said, FEPI and RDTE. And then I have these residual options that I still have. These, so I got some, like a lot of money tied up into the T triple Qs with some leaps. I got a lot of money tied up with Google. Google's undergoing some lawsuits because people were saying that they built in their search defaults for Google, and it was like a little bit not fair. So they're going through some lawsuits. So it's hard to say, but it seems very promising. I still think Google still has a lot of promise in the long run, but things could change. And then I have these, like I mentioned, BITO, which is a futures. It's both an option play, but also a high yield dividend play. I have to figure out what I'm going to do with this. Either just keep doing cover calls and collecting the dividends, or build up the position and do strangles. It's kind of I have to figure out and get my um, you know you know get my determination down. You got to make a decision what you want to do with this position. So yeah, and just wanted to talk about the what's going on right now. So yeah, we're gonna be. My anticipation is, like you can see right now, we are right now $35.5 trillion, $35.35 trillion in debt. And whatever party, I don't want to get into politics here, but I think we can all agree that national debt's getting worse and worse and worse. We're doing a horrible job as a government to deal with national debt, and it's going to basically really cause inflation. Whatever prices you think are going to be more expensive. Government handouts have to come from somewhere. It's got to be funded from somewhere. So when it comes to inflation, like anything that happens, up market, a down market, a neutral market, there's always a smart investor would always look for strategy. Strategy is always something to do with any type of market. So if you know that inflation is happening, there are losers of inflation and there are winners of inflation. So if someone puts their money under a mattress or save a 0% interest savings account or a fixed income, if your income is fixed and inflation goes up, your income is going to be withering away with inflation. It's going to basically cannibalize your income. Same thing with your money. If you have your money under your mattress, it's just going to keep getting your buying power. Your buying power will just be less and less. Fixed income, you know what I mean? So you need to be able to, and look what it says here, workers and fixed income. So most of our jobs, I would say, is almost fixed income. Most of our jobs, they barely give raises. Maybe like, I'm talking about like 5-10% raises every single year over year. Maybe some people are blessed with that, but I feel like most employers are way behind the inflation, the rate of inflation. And by doing these high yield dividend ETFs, you're putting yourself in charge of your destiny, and you're able to have control over your income, and your income increases. And then, so that's one thing why I find it very powerful. Another thing is that the winners, like if you have fixed debt, like some people have mortgage payment debt. So if you're locked into a mortgage or a fixed debt, a fixed income debt, right now the debt may seem like a certain, let's say someone has $100,000 in debt, but it's fixed debt mortgage. That's actually not such a bad mortgage, right? In 10 years from now, with the rate of inflation, that $100,000 will look like $50,000, let's say hypothetically, in 10 years. So basically, like, it won't look that bad. It won't feel that bad, because eventually income would go up, and inflation will basically erode your debt. The government is using inflation to make their debt be perceived as less. So if you're on a fixed debt side, then I would imagine that would be eroding your debt slowly over time. I'm not saying debt is good, but I'm saying a fixed debt, if it's manageable on the side of inflation, it helps. Owning land, physical assets. Some people I've seen argue that say that owning stocks, or they're not physical assets, they're paper assets, but they're based on companies. And as inflation goes up, companies will increase their prices, and as companies increase their prices, they kind of hedge you against inflation. I've heard that, that theory. So yeah. Anyways, that's my 2 cents. I hope you guys are all doing well. This is the Working Investor over and out. I hope you guys have a wonderful day. Take care.